Hey everyone, welcome back to another dividend investing video. And happy holidays! We are releasing this video on Christmas Day, and I hope your holidays are filled with joy and that you can take the time to appreciate the people and things that matter most to you. In addition to the presents under your tree, in the month of December, many wonderful companies gave us the gift in the form of dividend growth. That's right. Those of us who own shares in these great companies get a raise simply for holding the shares. And today I'm going to go over many of the notable dividend hikes we've seen in the month of December 2023. I consider these candidates for your watch list. They're not buy recommendations, but I will give you my brief thoughts on each of them so you kind of know where they all stand in terms of a long-term investment perspective. So let's dig in. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Now, if you own any of the companies we're talking about today, I want to hear about it down in the comments. Are you happy with your investment? Also, are you looking to add to any of these in particular? Just let me know. And by the way, I'm getting the graphics here from simplysafedividends.com, and I'm going to also provide you with the dividend safety scores for each of these companies as well. So we started off the month on December 1st getting an announcement from Bank of Montreal, ticker BMO. They announced their dividend hike of 2.7%. BMO has an incredible track record of paying dividends since 1829. And that's 28 years without a dividend reduction. The dividend growth streak is 2 years. It was frozen for a short period during that COVID crisis, but they've more than made up for this. This is the second dividend hike they've announced in the last year. So all in all, their dividend has grown by 7%. And they've announced a raise every 6 months since resuming their dividend increases. I know banks in the US were required to freeze their dividends for a period. I'm not sure what Canada did, but it's probably similar there. You have until January 29th to get your shares for their dividend payout on February 27th. And I think this one looks to be reasonably valued today. A quality bank to own. I would love to own this one. The dividend safety score of 70, it's pretty solid as far as banks go. Next up on December 4th, we saw Alexandria Real Estate, ticker ARE, announce its 12th consecutive dividend increase at 2.4%. ARE is a life science REIT with a 94% occupancy rate with a tenant base of companies like Pfizer and Amgen. This is also the second dividend raise for Alexandria in the last year. So their dividend is up about 5% over where it was last year. And this is in line with their standard dividend growth rate. 5-year average is 6% annually. As with most REITs, shares are valued attractively right now after a terrible 2023. Now, I'm not crazy about office REITs, but if I did have to go with one, I think this would be it. I do believe their niche in the life sciences, that type of research, it's not going to really lend itself to remote work like we're seeing across a lot of other industries. So I think they're safer there. The ex-dividend date is December 28th, so you have your shares for that December 12th payout for ARE. They have a dividend safety score of 76. Moving to December 5th, we saw a few dividend hikes. The first was from CVS Health, ticker CVS. They upped their dividend by 10%, going from 60.5 cents to 66.5 cents. While they've been paying this dividend uninterrupted for the last 26 years. The dividend increases only resumed last year after a 5 or 6 year pause, but you want to have your shares by January 19th to get their February 1st dividend. It's not really a company I'm personally interested in owning, but it is valued attractively. The yield that is 17% above its 5-year average. They do have more going on than their retail stores. They also have healthcare benefits segment, which provides insurance products, but you could put me on team UNH. I think the CVS dividend looks generally safe with a dividend safety score of 90. Next on the 5th, healthcare equipment maker Stryker announced a 6.7% dividend hike, extending its dividend growth streak to 32 years of dividend raises. Shares look reasonably valued for Stryker, not much in the way of yield at 1.08%, but great track record and has been a compounder with a 10-year total return of 351%, which soundly beats the broader market. Have your shares by December 28th for the dividend payment on January 31st. Their dividend is easily covered, only 28% of forward earnings and a Simply Safe dividend safety score of 90. It doesn't get a lot of coverage, but I think this is an underrated company that belongs on your watch list. Another solid low-yield, high-growth company announced on the 5th is MasterCard, ticker MA. And when they announced their 12th consecutive annual dividend raise, hiked their dividend by 16% from 57 cents a quarter to 66 cents. As with most low yielders, we want to see that total growth over the last 10 years. We're talking 452% total growth. That's more than double the broader market. Now, I don't see that double-digit dividend growth slowing anytime soon. I think younger investors should either be in one like this or Visa. They're both very similar. You ought to have your shares by January 8th for the February 9th dividend payment. With a dividend safety score of 99, shares do look slightly undervalued. I would have no problem adding to MasterCard right now. Then on December 6th, big farm giant BristolMyers Squibb, ticker BMY, announced a dividend hike of 5.3%. They have a dividend safety score of 70. It was actually just downgraded from 79 due to their acquisition of Karun Therapeutics for $14 billion. So that could add some short-term strain on things. But we have 16 years of dividend growth from BMY, 52 years of uninterrupted dividends. So the track record is there. Have your shares by January 4th for their next dividend payment of 60 cents on February 1st. Could be an interesting time to load up on shares as they are down 27% year to date. Could they turn things around? I think this will be a company to watch closely in 2023. I myself am on sidelines right now. Moving along to December 7th, let's look at Ecolab, ticker ECL. They boosted their dividend by 7.5%, marking its 32nd year of consecutive increasing payouts. ECL is a company that specializes in the treatment, purification, cleaning, and hygiene of water in a wide variety of applications. This is probably the least talked about sector in investing materials, but this is a decent company for investors who want some coverage there. 1.15% yield is 15% above its 5-year average, and they have a dividend safety score of 98. So add this one, Ecolab, to your watch list this holiday season. Also on the 7th, one of my favorite stocks also happens to be my top performing company of the year, Broadcom, ticker AVGO. They announced a 14% raise. This was a 13th consecutive year doing so. Broadcom is in the semiconductor industry, and Simply Safe Dividends gives them a safety score of 67. They feature one of the most aggressive dividend growth track records of the last decade, with an average annual growth rate of 36% over the last 10 years. But with shares 41% below their 5-year average yield and a higher than usual PE, I'm not really keen on adding a whole bunch right here. I do wish this is one I had bought more of earlier in the year. Another one on the 7th, self-storage company CubeSmart, ticker CUBE. They announced their 14th consecutive dividend raise at 4.1%. This is another REIT. They have been doing a fine job growing their cash flow and their adjusted funds from operations. Compared to other REITs, this isn't a screaming discount as it is up 17% year to date. But I think the best time to build into this one was back in October when all REITs were being hammered. It's definitely worth keeping on your watch list, though. I own some in my Roth IRA. I'm very happy with it. They feature a dividend safety score of 61. The last one on the 7th was from animal medicine firm Zoetis, ticker ZTS. I think I'm saying that right. They announced 15% raise, double digits, marking for their 10th straight year of growing dividends. This is another low-yield, high-dividend growth company with a 5-year average annual growth rate of 25%. And get this, a 10-year total return of 546%. So are you noticing a pattern with these low-yield, high-growth companies? I hope you're seeing it. Now, from a dividend yield theory perspective, the yield is 38% above its 5-year average, making this an interesting time to look closer into Zoetis. And I think you should at least add this to your watch list with a Simply Safe dividend safety score of 74. Santa gave us a lot of dividend hikes this year. Still have a few more companies to look at. The next is from December 8th. Eli Lilly, ticker LLY, announced a 15% dividend raise, which marked its 9th consecutive year growing their dividends. They've been doing this at double-digit rates over that time frame. The dividend looks safe with a very safe safety score of 96. The dividend looks easily covered, but I don't think I'm looking to start a position here at this level with a yield that is 43% below its 5-year average, and the PE is way above its 5-year average. I just can't justify today. But no doubt this is a quality company in the pharmaceutical space. They are massive at a $500 billion market cap. If interested, you have your shares by February 14th for their next dividend payout on March 8th of $1.30, and that's Eli Lilly. And here's one in our channel's public portfolio, Waste Management. On December 11th, Waste Management, ticker WM, announced a dividend payment of 75 cents, which is 7.1% above its prior payment of 70 cents. This is Waste Management's 21st consecutive year of dividend growth. This is a company that is almost always trading at a premium because they're a quality business. They provide an entirely necessary service throughout the US and Canada in the handling of waste and recyclable materials. So it's hard to time this one. I think if it's one you want to own, you just buy into it and hold it. It's been doing well for investors with a 10-year total return of 400% and a Simply Safe dividend safety score of 74. This is really one of my favorite companies in my portfolio, Waste Management. Then moving on to December 12th, we have a slew of raises. The first is from good old reliable Realty Income, ticker O. They announced their 123rd increase since 1994. The monthly dividend company announces quarterly raises like clockwork. Today's shares are yielding 5.41%. This is 23% above its 5-year average, and I love this one above a 5% yield. With a low price to adjusted funds from operations, I think shares are attractively valued right now. I've bought at least $1,000 worth of O over the course of 2023, and I'm sure I'm going to buy more in 2024. They have a Simply Safe dividend safety score of 80. To me, there's a no-brainer for the dividend investor. Then we have healthcare biotech firm Amgen, ticker AMGN. On the 12th, they also announced a raise of 5.6%. This is the 12th consecutive year of dividend raises for this company. This is another one we hold in our portfolio here on the channel. They feature a dividend safety score of 74, along with double-digit dividend growth rate on both a 5 and 10-year time frames. You want to have your shares by February 15th to get that next dividend payment of $2.25 on March 7th. Amgen looks to be trading near its fair value right now, reasonably valued with this yield of 3.17%, being right in line with its 5-year average. So perhaps one to look to add on a dip. Now, one more REIT I'm going to cover today, and that's Mid-America Apartment Communities, ticker MAA. They announced a 5% dividend raise. This is their 13th consecutive year of dividend growth for this apartment company. Rising rents have boosted this company's AFFO per share, and this is an appealing choice right now. We have a dividend safety score of 97, looking rock solid with low payout ratios, a dividend yield of 4.42%. This is 39% above its 5-year average, and its P to AFFO ratio of 16.2 is far below its 5-year average. An interesting way to collect some rent checks without the landlord responsibilities. I love it, but I don't own it myself at this time. Then one more boost on the 12th. That is from Franklin Resources, ticker BEN, B-E-N. They are an investment management firm that helps people achieve their financial goals. They've boosted their dividend by 3.3%. And this is their 43rd year of consecutive dividend raises. The firm has a dividend safety score of 70. Shares are trading around fair value from what I can see. It's not super appealing to me. I do see a consistently growing payout ratio and declining earnings per share and free cash flow. So I'm investing elsewhere. There's too many things trending in the wrong direction with this company. Although I could be wrong. And if you think I'm wrong, have your shares by January 2nd to collect the next dividend payment on January 12th. Then on the 15th, this one's a little controversial right now. Pfizer, ticker PFE. They announced a 2.4% raise. And this is their 15th consecutive dividend hike. They had a terrible 2023. Shares are down 44%, absolutely clobbered. This has brought the company's yield to nearly 6%. This could be a turnaround play, but it is risky. The yield is 52% above its 5-year average. The payout ratios are edging high. It's a little concerning. The dividend safety score is at 75, rated safe. So buy into Pfizer at your own risk, but you could be heavily rewarded for doing so, I would say. They've really been beaten down, and perhaps this is an overreaction. Another healthcare company, we're talking about Abbott Labs, ticker ABT, a dividend king, announcing their 52nd consecutive annual dividend raise. Simply Safe Dividends gives Abbott a safety score of 90, very safe. And its 2% dividend yield is 25% above the 5-year average, making this an opportunity to lock in a higher than average starting yield for a classic dividend king. I know their spinoff company AbbVie is a lot more popular in dividend circles, but I think Abbott is also high quality. The healthcare maker features a low payout ratio, low debt, growing free cash flow per share. There's lots to like here. And then the final company I'm going to feature today, we're talking about WEC Energy, ticker WEC, who on December 20th announced a 7% dividend raise, extending its growth streak to 20 years. This is an electric utility company that services in Wisconsin and Illinois. And for a utility company, 7% is solid growth. And this is their typical. They raise their 5-year average annual dividend growth rate is 7%. And the payout ratio of 71% is attractive for a utility. It's pretty low. The current yield of 4% you can lock in, 36% above the 5-year average. They feature a Simply Safe dividend safety score of 87. So this is not a bad choice if you want to up your exposure in the utility sector. good time to look into WEC Energy. Santa has been good to us dividend investors this holiday season. He's been great to us, but we have lots to be grateful for, and I'm grateful for every one of you who have been supporting our channel and the work here over the last year and spreading the love of dividend growth investing. We have lots more to come in 2024, so do make sure you are subscribed and have those notifications turned on so you don't miss that next video. And until next time, my friends, keep investing.